Hello and welcome to the Alt Asset Allocation Podcast. Today's interview is with Mark Dissen and is all about potential tax savings specifically for Americans living or working outside of the US. This may seem like a little different than some of our other episodes. It is. However, whenever you have lower returns on your investments, taxes and fees can make up a significant difference for you in net returns. This, coupled with the fact that many companies have gone remote or work from anywhere, perhaps looking outside the US for your next stop might make sense. Tax advice is very difficult to give in a broad brush manner, but I've been living abroad for 9 of the past 11 years, and these rules really made a difference for me. Yes, we love the US. I'm back now. I definitely missed it. But did you know that the US and Eritrea are the only countries on earth that tax you for being a citizen? Eritrea is a very small country in East Africa, if you were curious. It's pretty wild, but don't give up. As discussed on this podcast, there are some ways to save big on taxes while working overseas. In this conversation, we discuss how Americans can save big on taxes when working outside of the US, what you need to know, and what you need to watch out for and to take advantage of these significant savings, which means more investable cash at the end of the day, or more cash to spend whatever it is you spend your money on. Doesn't have to be investing. Should be. This is a large topic, and I hope this conversation serves as a catalyst to get you to crunch the numbers and realize the potential benefits of living abroad for a few years. It really might surprise you. Before you listen, please don't forget to like or subscribe to the podcast, or even better, leave a review. This really helps more people find the podcast and keep this thing going. It really, really helps. Taxes. This sounds boring, I know, but it can really, really pay dividends. And actually, I quite enjoy this stuff now, which is weird, I know. Enjoy this conversation with Mark Dissen. Good morning, everybody, and welcome to the Alt Asset Allocation Podcast. I'm here with Mark Dissen, who's the founder of WayFarer Accounting. He's a CPA specializing in tax for US citizens, working primarily with expats and digital nomads. Welcome, Mark.
Thank you. Thanks for having me on here, Ben.
Good to see you. Where are you right now?
I'm in Pittsburgh, Pennsylvania. It's a boring town, but it's where I grew up. So here hanging out until COVID's over pretty much. I have a lease, like in a real house, finally, after 3 years of travel.
Hey, congrats.
Doing what I can to enjoy it. Thanks. Yeah. Trying to figure out how to be a normal person.
I am as well, actually. So we met last year, probably in October or November in Barcelona. Both of us were kind of doing the digital nomad thing. And it seems like the rest of the world has kind of caught up to this, hey, you can work anywhere. And it seems like you and I both are in the same case, that it's like, I just want a house now. I want a permanent location. So I think we're a little bit against the grain in that sense, right?
Yeah, it's happened to me. This is the second time it's happened. And so like, I'm like, I know I want a house. I want a permanent location. Then I come back and like 4 months later, I'm like, I need to get out of here. And so, give me a month or two and I'll be itching to be on the road again, I'm sure. But
yeah, definitely.
Comes in cycles.
I'm excited to have this conversation. We talked a bit about it, but this podcast is all about investing in alternative assets. But the prospective returns on a number of different asset classes are looking like they might be a lot lower. So transaction fees, taxes, these will make up a gigantic portion of your returns. And if you can optimize these and lower these where you can, then you have more take-home pay, more returns in your pockets. So I wanted to have this conversation because a number of employees, people that have never worked remotely, worked abroad, are now starting to venture out into the world. And you are an expert in working with these digital nomads or expats, people outside of the US, and working with them to save money on taxes, which means they have more money in their pocket that they can invest in these different types of alternative assets or invest in themselves, obviously. So I wanted to start off today, just a little background of you and WayFarer Accounting and what exactly you're doing.
Yeah, definitely. So I'm CPA, like for accounting firms, KPMG, and I was doing forensic accounting for them. And I think probably maybe like some of the people listening to this podcast quickly got fed up with the corporate culture and wanted to take off and do something on my own. So I left and started my own practice, and it's called WayFarer Accounting. And right now I work with, like you said, expatriates all around the world. We're in like 40 some countries or something like that, offering tax planning, tax preparation, consulting, and bookkeeping, and things like that. But my clients are all these people who, were living normal lives and decided, like I did, just to leave the US and take off and find some other plan. And, for a lot of them for me, when I first started, it was intimidating for a number of reasons. But one of the reasons was because I thought it was going to be financially devastating. I mean, I had saved up, money to do it, and I thought I was going to spend all my money doing that. But in reality, it can actually be one of the most financially responsible things you can do. And in my case, I mean, I earn money by doing this, and it can, it's something that I try and preach now. And one of my missions is to bring more digital nomads into the world, because I think it's a fun experience as well as a responsible decision.
Definitely. And this is something I tell my family and friends here, that financially, it will never make sense for me to live in the US. It's once you've realized this, you live in a mansion for $1,000 a month. I never cooked, and I'm still spending a couple $1,000 on food. Like your living expenses are so much lower, and everybody I talk to here is just, how do you live like that? And it's like, I do whatever the heck I want. It's great. Yeah. So it's certainly a different mindset for sure. So I wanted to start, how many countries in the world tax their citizens on global revenue, global income, wherever they are in the world?
Well, a lot of different countries, they all have different laws. I think maybe the question that you're kind of getting at is based on citizenship.
That's what I meant. Sorry.
So yeah, it's all right. So the US is one of two countries. There's another African country. I forget which one it is actually.
Eritrea. I just read it.
Eritrea.
Okay. Mind-boggling.
Yeah. I haven't been there. US and Eritrea apparently are the only two countries in the world that tax purely based on citizenship. So if you are a US citizen, no matter where you go in the world, regardless of how long, even if you leave and are gone for 20 years, you still have to pay US tax, or at least you're responsible for paying US tax and filing a tax return, which is annoying if you're a US citizen, especially when you get into this expatriate realm and you start hanging out with Europeans down in South America and stuff who are able to escape it. So something we have to deal with.
Yeah. And I think this is an important thing, an important key concept, right? Because a lot of people move abroad and they're like, I'm not in the US. I don't need to pay US taxes anymore. They meet their European friends that are getting around it. And it's like, oh yeah, we're probably like that too. But in fact, you're not, right? So if you were to talk to these new digital nomads, work from anywhere people, how would you start them off? Like what concepts would you want them to know about? Just talk to me like I am a newly found digital nomad that wants to go live abroad. How do I start saving taxes? What should I know?
Yeah, well, it depends on everyone's situation, and I think probably the biggest factor is, are you an employee versus do you have your own business? Because that can have a big role in what you're paying in taxes. But in terms of foreign concepts, international concepts, income exclusion is the real popular one, and the biggest one that applies to most people when they first start, at least. And what the foreign earned income exclusion is it's a tax rule. It's a tax break that allows you to exclude up to about $106,000, $108,000. It changes every year, it goes up a little bit. $108,000 of your income from income tax. So if you're earning $108,000 or less and you qualify for this exclusion for the full year, you can exempt all of it from income tax and pay $0 of income tax on that income. That doesn't exempt you from things like self-employment tax and payroll taxes and things like that, but it can still be a big chunk of money. If you're earning six figures, it can be $18,000, $19,000. It's a lot of money per year. So there's two ways to qualify for that. One is called the physical presence test, and to go that route, you have to be outside of the U.S. in other countries. It can be more than one country for 330. It doesn't have to be a calendar year. If you are gone for that amount of time, then you can qualify for the exclusion that way. And then the other route to qualify is called a bonafied residence test. And that's if you become a full-blown resident of another country. So say you move to France, get your full-time, full long-term residence visa, start paying taxes there, maybe you get a spouse there or something like that, then you can claim the exclusion that way and don't need to worry about the number of days that you spend in the US.
Yeah, and I want to dive into each of those in a little bit more detail.
Sure. Yeah.
But just on FEIE, foreign earned income exclusion, that's the abbreviation. So for a lot of these people that are getting, I've never done this as a
Sure.
employee from an American company, but American companies normally deduct the taxes from your payroll each month. So does this mean at the end of the year, there's a calculation and I get a massive refund for all of those taxes that have been withheld throughout the year if I
Often,
qualify for
yeah.
the FEIE?
Often that would be the case, especially in the first year. There is a route you can go where you decrease the withholding that comes out of your paycheck every period. But at least in the first year, and some people just keep it this way. Yeah, what will happen is they'll keep withholding the same amount from your paycheck every period, and then you'll just get this big refund when you do file your tax return, which always makes everyone happy. So
Yeah, that's a nice surprise. And then
yeah.
on FEIE as well, you can do partial years and you can kind of have this rolling window of 365 days, right?
Yeah, exactly. And so, if you were gone from June 2020 to June 2021, you can take like 6 months in 2020 and then another 6 months in 2021. Or if you're gone for 18 months, you can take the full 18 months. It doesn't need to be exactly 12-month chunks. Like you said, it's on a rolling kind of basis. So 330 days out of 12 months. But that 12 months can, once the first month drops off, you add it to the next. If that makes any sense.
No, it kind of does. I mean, this is so I've done FEIE for the last 6 years, and now I've moved back to the US, and so now I'm looking at this partial year, and if I go abroad again, I'll have to figure out this rolling situation. But the concept that it's rolling and you can take a partial year of FEIE makes sense, and that's why we pay somebody like you to figure out the nuts and bolts of all of it as well.
Exactly. Yeah.
Okay. So now to qualify for the FEIE, and this is 108,000. So this is one of the biggest levers that expats or nomads can pull to have savings on taxes.
Yeah, I mean it's the easiest to comprehend, I think, for most people at least, because I mean you're just like with the physical presence test, you are out of the country for long enough. So it's once you kind of get, like you said, those nuts and bolts down, the little intricacies of it, once you understand those, then it's pretty straightforward and pretty easy to do. So say that's just at the federal level. So most states will recognize this foreign earned income exclusion too. Not all states do. The big one that doesn't is California. So if you somehow remain a California resident, I know, Ben's smacking his head here. If you remain a California resident, and even if you do qualify for this FEIE, at the federal level, California will recognize it. So you end up paying state tax. The reason I'm saying this is because you can also then find other ways to avoid state taxes, or the same way, depending on what state you're in. And that's going to add to your tax savings then. So when I said $18,000, $19,000, that's just federally. So depending on how much you're paying at state level too, you can avoid that by moving out of the country, becoming a resident somewhere else, or just not living in the U.S. That's in addition to the FBA.
And so there's a few states within the U.S. that even if you're not a resident physically there, you'll still have to pay, like California. But so some of these other states, if you're not there, what are kind of the high level guidelines that you can legally avoid these state income taxes while you're doing the FEIE as well?
Yeah, I mean, well, it depends on the state.
Right.
Some states don't have income tax, so you don't have to worry about it. But let's say the most straightforward route is to no longer be a resident there. So you don't have to be a resident of a state. You can be a resident of China or Guatemala or whatever you want to be a resident of, and so you can go that route and try and be a resident of another country, or at least argue that you are, so you don't have to pay tax as a resident in a certain state. Some other people like to transition to a no income tax state first, so their first month or two of their digital nomad life in Florida or in Texas or Washington and some of these no income tax states, become a resident of there, so that they detach from that prior state and can no longer be responsible for state income tax. How that works, by the way, if you're not a resident of a state, if you travel to a state just temporarily and earn some money while you're there, you'll file a non-resident tax return. So let's say you go to New York for a month. you earn $5,000 while you're there, you will only pay tax on that $5,000, but you don't have to pay tax on your full year's worth of income to New York just because you're there temporarily. Hopefully
Right.
that made sense.
No, that makes sense. And I want to dive into that in a little bit more detail, obviously for my own benefit as well, because I'm bouncing around the US like a gypsy person. So to qualify for the FEIE, you have the physical presence or the bonafied residence test. The physical presence, you need to be in another country for 330 days. So something that always surprised me was international waters, flights, when you're in the air, space. These things don't qualify. Yeah. So if you happen to go to space, you're technically in the US in terms of tax purposes, right? Well, you're not in another country.
Yeah,
rather.
You're not in the US. Yeah, the rule, a lot of people say you have to be out of the US for 330 days for semantic purposes. But the rule is that you need to be in a foreign country or multiple countries for 330 days. So if you aren't in a country, if you're in international waters, is usually where it comes into play. Then that doesn't actually technically count towards your 330 days. That doesn't, you don't see that too often. I think I've seen it twice before where people had done the cruise just across the Atlantic, usually for digital nomads, where they spend 7 days in the Atlantic, and that technically doesn't count towards their 330 days, so they can get a little caught up there. But this technical rule, it doesn't seem often, but it is there. Yeah.
Oh yeah, I took an 18-day cruise in December of last year, and it was very worrisome, like how many days we were in international waters, but it was just a few, so it wasn't that bad. With physical presence under the FEIE, what are the biggest issues or most common mistakes you see when somebody tries to qualify for this?
Well, first of all, it's all or nothing. So 329 days does you absolutely no good. So I have seen, I think, a couple clients just miscount, and they were like 1 or 2 days off, and they lost like several $1,000s because they spent 1 or 2 extra days in the US than they had. So that's a mistake people make. I like the physical presence test because it's just so objective, and it's were you out of the country or were you not. There's not a lot of errors to be made. Another point of confusion, let's say, though, I touched on this a little bit earlier. It only covers income tax, and so if you are self-employed, say you have your own business, it doesn't cover that self-employment tax, which is about 15%. So you'll have to pay that still. You don't have to pay no tax every year. You still have to pay a little bit. And it also only covers earned income. It's called the foreign earned income exclusion. So it doesn't cover unearned income. Unearned income means things like dividends and interest and capital gains, things like that. So if you sell your house before you go, or after you go, it wouldn't qualify because you still have to pay tax on the capital gains.
I guess you could do some quick, sweet financial engineering, thinking about retirees. You could pay those interests or dividends into a LLC and then pay yourself a salary from that LLC.
Not really. No.
Everything always seems so much easier in my head, and then you tell me it's a boneheaded idea. That's for sure.
An LLC is something called a disregarded entity. Yeah. And so if you pay yourself from an LLC, it has no impact tax level. It's like, because it's just you paying yourself with your own money, basically. It'd be like transferring bank accounts. So it wouldn't really work that way.
Damn. Well, if it seems too easy, it probably is.
Yeah.
Maybe into an S corp, maybe into somebody else. Yeah.
Maybe there's something there, I'm sure. Yeah. Maybe.
Oh, yeah. Walk me through this. I'm a digital nomad. I'm bouncing around. I'm spending I'm out of the US for a couple of years. So I qualify for the FEIE, physical presence. Yep. Sure. I'm a month in Spain, a month in Portugal, a month in Morocco. Countries are broke. Governments are broke. Are you like the state version of this? You're liable for income taxes in those countries in which you're working from, but this is just something they never really enforce because they're not able to. Can you walk me through what that looks like, that potential tax liability of bouncing around and not paying taxes in each of these countries?
Yeah, well, so I'm a U.S. accountant. I only handle, U.S. taxes. I don't know United Kingdom rules or Spain's laws or anything like that. But the general answer is that every country has different tax laws, and so theoretically, before you would go to each of these countries, you would research the tax laws and follow them. Enforcement is I'd say non-existent pretty much, and in practicality, people are just going there on a tourist visa a lot of the time, spending a month there and then leaving. Some countries, that's totally what you're supposed to do. You don't have to pay tax if you're just there for 30 days. Other countries, you're supposed to be there on a work visa, not a tourist visa if you're working. I think there hasn't been much effort to make rules against this to prevent this from happening, because when people travel there temporarily, they're not leeching off, the health system and the government programs and things like that without paying into tax. In fact, they're actually just bringing tourist money into the country. And so there's not a lot of like resistance that I'm seeing. But short answer, every country's got different rules, and I'm not exactly sure about what every country does.
Right. And typically you're not taking local jobs. You're earning this income outside of the country in which you're traveling. So, it's a net positive for the country to have these people come and spend their money there overall.
Yeah.
In my
opinion. And I'm starting to see the opposite, actually. It was, as opposed to enforcement of taxes against people who are coming in, they're actually encouraging people to come and say, as long as you don't take a local job, which that's not who I work with. As long as you don't take a local job, you can come and work here on a digital nomad visa or something like that, or a temporary visa, and just bring your money and you're welcome.
Which I would expect. There's a number of these in the Caribbean that are kind of raising their hands now, but I think Serbia did it sometime last year or the year before, and they said, hey, digital nomads, come here, work here for 90 days, we won't tax you. And everybody kind of scratched their head like,
where we gonna be?
Yeah. Well, it's kind of nice. But, I think more of these, like, why wouldn't you? Tourism is down. You have some like longer term tourist person who's working online for a US company or whatever, and they're spending their US salary within your economy. So I think there's a lot of benefits there. So that's physical presence, pretty plain Jane, pretty easy to understand. Now walk me through bonafied residence, which is the other test to qualify for FEIE.
Yeah, I'd say it's the least common, it's the lesser common among my clientele. I'm not exactly sure about broadly over the world, but the second way to qualify for this 400 income exclusion, it's called the bonafied residence test, and it's a little more subjective than the physical presence test. It's not one concrete rule. It's based on a number of factors, and technically it's on a case by case. And so it's when you are it's for when you're a full-time resident of another country. And so they'll look at things like, what type of home do you have there? Are you renting? Did you buy? Is your family there? Do you have kids there? Are you paying taxes there? How much time did you actually spend there? What type of visa were you on? These all go actually on the form, all those things I just listed. And so it's based on this broad number of factors, and not one one single of those factors is disqualifying in certain ways. So you don't have to have family there to claim the bona fide residence test, but they look at a full picture of what you're actually doing. I've never had it rejected, but technically they could say, no, you're not a resident there. So what you do is you claim it on your tax return on Form 2555, say I'm a resident of X country, and here's the reasons why and what I'm doing, and you just claim it, and then in theory you could get audited.
And that's the most terrifying part about this, in my opinion. I mean, you're like assuming that you're going to get this $20,000 deduction from your foreign earned income, and then suddenly they're like, no, you didn't qualify because you whatever, and then you're liable for a $20K bill at the end of the year. That's a bad surprise.
I've never had it happen, like I said, but usually these people, I mean, you're only really running that risk if you're being kind of shady about it. I mean, you take that bona fide residence test if you are a resident of another country. Some people will try and like sneak it in with me, and I say like, no, that's just not do that. But it's not. I say it's subjective and less concrete, but like, most people know if they're a resident of a country or not.
And what are kind of the big ones that you need to keep in mind? So you need to have a rental there. You need to have some income in that country, so you're paying some taxes. What are like the big ones that you definitely have to tick those boxes before you can even think about going for a bona fide resident?
I don't know if there's one single one that you definitely need to have. I think the one that really helps is if you have family there, or and by family I mean people that you're living with, so like a spouse or just children or something like that. Although
so
that's
you need
certainly
to
not
marry
just
a local person wherever you go.
I mean, that would be great. I personally have always wanted to marry a European for the healthcare, although I can't find anyone to do it. But
same. So anybody listening to this, we want European passports.
Yeah, any Swedish girls out there, just let me know. No, but that's one thing. Are you paying taxes there? What is a red flag that you don't qualify is if you're just permanently on like a tourist visa. Some people in Thailand are on tourist visas, and definitely they stay there for 30 days and then leave and come back and get another tourist visa and stuff like that. I think that's going to work pretty strongly against you. You really want to have some sort of residence visa or be working towards a long-term residence visa. You don't just want to be permanently like an ongoing tourist.
Yeah, and I wish I would have listened to this podcast before I started my expat route, because I was doing the physical presence test for the 4 years that I lived in Thailand, that I was working for an American company on a residency visa, paying taxes in the country, had a own apartment sort of thing. So I definitely ticked the boxes, and I stuck to this 330-day rule, and I was only limiting my US trips, less than 25 days, just so I had a little buffer sort of thing. And because that works better for me. So, and what I'm talking about there is 330 days in another country, or roughly, 25, 30 days in the US to add up to that 365, which I know is the wrong way to do it, but it worked better for me. Okay.
Yeah. It'll get you on a leap year. So it'll get you.
That it will.
And it just to make that clear, that is the benefit of the bona fide residence test over the physical presence test, is that you don't have to worry about the number of days you spend in the US. If you are a bona fide resident of another country, you can go to the US for 2 months and, spend the holidays there or whatever it is, and still claim it. With that said, with both these tests, with the foreigner and income exclusion, you always have to pay tax. So if you do go to the US for 2 weeks or a month or whatever it is, and you earn a few $1,000s while you're there, you have to pay tax, income tax on that money, even if you're otherwise excluding the stuff that you earn abroad.
Okay, that makes sense. So for somebody owning their own business and wanting to take advantage of FEIE, can you walk me through how that works? I mean, a lot of what we've talked about is more you're like getting a salary each month and this sort of thing. But what if I have my own consulting business? I probably just have an LLC or an S Corp here in the US. How is this different for somebody in that case?
Well, it depends on what your structure is. So an LLC would be different than an S Corp, which would be different than a C corporation, which would be different than a foreign corporation income tax. And so you're still going to be paying self-employment tax if you're an LLC or sole proprietor, or you'll still be paying payroll tax maybe if you're a corporation. So I'm trying to figure out how to most usefully answer that question.
Maybe go through each one. So if you're an LLC, that it looks like this. If you're an S Corp, it looks like this. And then we won't cover foreign corporations because that's kind of a different animal, right?
Yeah, it's a bigger animal for sure. If you're a sole proprietor or partnership or LLC, it's going to be pretty similar. You're not earning a salary, but you're earning income, and that income is going to be considered earned where your business operations actually are, regardless of where your clients or your employers are. So if you're, say, a consultant working in Spain for US companies, that if you, as long as you're in Spain working and earning that money in Spain, that's still going to be considered foreign earned income and therefore qualified for the FEIE. If you have a bigger business, say you have an agency of some sort, you have to be a little more cognizant and careful of what you're doing. Or if you have a partnership where you've got multiple different partners working for the same thing, you need to be cognizant of where things like your partners and employees and warehouses and offices and things are, because just because you're in Spain, your business, which is bigger than you, might be working in the US, and then you'll have US income that doesn't necessarily qualify for the FEIE. So it can get a little blurry there if you're not just like a freelancer or a consultant or a sole practitioner or something like that. So that's at that kind of unincorporated level, let's call it. And then when you become an S corporation, it gets a little more complicated. I'm not sure how many people are going to be familiar with how an S corporation works, but usually what happens is you'll have two hats. You'll be an employee and you'll be the owner as well. The trick with that, or the catch, is that the owner, when you pay yourself as an owner, it's as a distribution, it's called, and that is considered unearned income. The distribution portion that you take from an S corporation, the part that you pay yourself as a salary as an employee, that's going to be considered earned and qualified for the FEIE, but your distribution is not. And so you have to change your strategy in terms of how much you're paying yourself when you have an S corp. That gets tricky, and is needs to be determined at a personal level. So I won't get too into that, but that's how it would work.
Yeah, so it sounds less incentivizing with an S corp, because obviously you set up an S corp so you can pay yourself a lower salary and a bigger distribution. So if you kind of flip that to take advantage of the FEIE, with income taxes, you'd really need to crunch the numbers to see if in fact it is saving you that much money to stay outside of the US. And obviously you have cost of living arbitrage and other savings as well that you need to factor in, but it's not as plain Jane, I'm getting a salary, I live abroad, I save 20K every year in taxes sort of calculation, right? Is that fair?
Exactly. Yeah, it's a little harder to tell, and you got to play around with it. And that's what my consulting is. I do consulting and sit down with people and go over the numbers and figure out what they should set as their salary and things like that. So I can help if anyone needs that. But it's not as straightforward, but it is definitely still advantageous. It's just that the advantage of an S corporation are less prominent if you're abroad than if you were in the US. You're still saving money though. It's not bad to have necessarily an S corporation abroad.
Saving money in taxes as well as the cost of living and all of these other things, right?
Oh yeah, which is, so overlooked in all of this. People talk of it like, and think of it like, that's nice, yeah. But people will look at their investments, and I'm sure people listening to your podcast are very interested in investments. You'll look at a guaranteed 15% annual return as like it doesn't exist. It's some holy grail. You'll never find that these days, except in tax. Because if you go this route and you're saving 20% in taxes, that's literally the same as you taking that money and investing it and getting a 20% return every single year. That, and if you factor in the cost of living, like you were saying, I used to live in Colombia for several months, and I'd come from Washington, D.C., and Colombia was a 24% cost of living of what it was in DC, according to online websites, Numbeo or whatever. And so that, it's like quadrupling your money, basically. You can think of it that way, or you can think of it of staying at the same 3/4 of what you make plus the taxes, and then you can invest that on top of it. So it's an addition to your investments too. So you do it for a couple of years, and you're off to a good start with investing and saving your money.
Exactly. And then, this is just kind of the gateway drug into this lifestyle. And I have a number of other interviews that I've done already, but, this is the start of flag theory. So you're in these other countries, exposed to this other economy. And then I have an interview with people about investing in overseas real estate. So perhaps, the potential for appreciation or a good rental yielding rental property in one of these foreign countries starts to make sense. Then you're acquiring this portfolio of international assets that aren't tied to your home country, where the majority of your assets are signed are locked up. So it becomes getting very, very interesting because you've got an extra 20K a year in savings if you're making over $100,000. So that's enough to start putting towards some real estate assets abroad, and getting very interesting and interesting tax returns, obviously.
Definitely, yeah. And on the other side of things, I'm not sure what demographic you're shooting for here, but if you're not that big, maybe you're not earning six figures yet, that's okay. Because what I did is I quit, like I mentioned, I quit the company that I was working for. I didn't have a salary, I didn't have income. And so that's one reason I was in Colombia, is because it was so cheap. And that's where I started my practice. And, when I was only earning, $1,000, $2,000 a month or whatever it was, just not a lot of money, or $500 a month, whatever it was. And you can still live a nice life, even when you're starting out your business or you're not earning that much money, and you still have all these savings. And, you're not saving $20,000 in tax, but at that point, saving $1,000 on tax a year matters, and it'll pay for your rent for 2 or 3 months too. So it's not just for the higher end of things. It could be people who are just starting out or not quite earning as much too.
Very, very good point. Yeah. I mean, your burn rate here in the US, you're paying $2,000 for rent and food and all of these things, transport, car, they add up very quickly, and you can go to a beautiful place like Colombia or Bali or Thailand or whatever, and spend just a portion of that, a small fraction. So it's a very, very good point. As people start their expat, digital nomad journey, and actually just to clarify, so an expat in my definition would be a person living in another country, and then a digital nomad would be somebody that is perhaps on a tourist visa, but more shorter term stays in a number of countries. Is that an accurate description?
Yeah, I don't know if I'm the ultimate arbiter on the terminology, but I think that would be the generally accepted terms. Is an expat would be someone who's moved abroad on a more permanent basis, whereas a digital nomad travels around from country to country or city to city or whatever it is, without a permanent base. That's calling. Yeah.
Okay. And what other tax things should these people know? So like FBAR, FACTA, like these other forms that only exist when you start going abroad.
Yeah, there's several things. We can start with the FBAR. That's something that will usually apply more to the expat side of things than the digital nomad side. That's if you have foreign bank accounts, or either one or multiple. So if you say you move to Spain and open up a Spanish bank account, you have to report that bank account and that balance every year when you file your tax return. And you have to do it if your foreign bank account or accounts have an aggregate balance of $10,000 or more US dollars. It actually doesn't even go to the IRS. It goes to a financial regulatory agency, and so it'll have zero impact whatsoever on your taxes. But there is a big risk for not reporting it. There's big penalties. I think the penalties are $10,000 or something like that. So it's just good
per bank account or something crazy, right?
Yeah, and then it gets worse, because then if you don't pay it in time, then they add even higher penalties and stuff like that. So it gets bigger and bigger. They just changed it recently. I think it's even now. It depends on how much money you have in the account, because if you have a lot of money, they might even increase the penalty. But anyway, it's not bad to file. So just file it even if you're not sure if you need it. It's relatively easy and no risk of taxes at all. So it's good to just get to know about that first of all, so that you can do it. And then once you do know about it, just file that every year. That's FBAR. FATCA is for a broader sense of financial assets. I don't have too many clients that really do that, but that's when you start dealing with different types of financial assets. So it's probably useful for people listening to your podcast. Say you have investments in a German company or something like that, and those assets are greater than $100,000 or go past the thresholds, you need to start reporting that stuff. Those thresholds change depending on where you live, if you're in the US or abroad. And there's different types of financial assets that will that you would need to report. Kind of handles that, so you don't need to really know the nitty gritty of all that. But that's called FATCA. as opposed to FBAR, which is just the financial accounts.
So the audio cut out a bit. So does this include, no, just for me, would this include real estate, gold, precious metals, foreign company ownership? Like, what does this include?
It does not include real estate. Gold, probably. I would say yes. I'm not entirely sure. Do you know anyone just treasure chests or something?
I mean, yeah, it's got this. I got this big Scrooge McDuck thing down in Argentina, just filled with gold.
This is completely sidebar, but I just read that there was this national treasure hunt in the Rocky Mountains. Some dude hid this. Did you read about that?
I knew about this thing since 2010. Actually, I had a buddy that told me about it. Yeah, it was in New Mexico, but he hid $1 million in gold. Well, or whatever the value was then and now, I don't know. But so he just loved the outdoors and wanted to encourage people to be out and exploring the wilderness. So he did this scavenger hunt. Yeah, man. Nick, if you're listening, I'm sorry we never went down there and searched for it. I didn't think it existed. I thought it was like a wives' tale.
And they found it, and now they're rich. I just found out about it, but I wish I had known, because I would have dropped everything and gone and searched.
Absolutely, I love hiking. Anyways, it's just like a more adventurous hike. It's a legit treasure hunt, right?
Yeah, exactly. Anyway, so me and my girlfriend were Googling this, and we actually found there's a treasure hunt in DC this upcoming week, and there's a $10,000 prize. Nice. They just have this like a weekly, and you can buy admission and you get $10,000 if you find the treasure. So
I link it. I like it. I'll link it in the show notes. Send people out and about, man. You got to do something.
Yeah, it's COVID friendly.
Yeah.
Anyway, gold. So I think probably you would have to report that. Real estate, no. Investments in foreign companies, yes. Stocks and things like that, and ownership in corporations, you have to report that. And so if you're not sure, the IRS just lists it out. You just Google FATCA IRS, and there'll be like do I need to report this? And then it has a list that says yes, and it'll actually delineate between FBAR and FATCA what needs to be reported on what.
Well, yeah, and then there's the other one, the 5741, if you own more than 10% of a foreign entity, right?
That's 5471. Yeah, I think that's different. So Form 5471 sucks. It's to put it straight. That is if you're a U.S. person. U.S. person can mean individual or a corporation, non-U.S. So if you say are an individual and you set up a corporation in Hong Kong, even as a shell, you need to file this Form 5471. It's a really, really complicated form that triples the size of your tax return and has extremely high penalties for not filing it or just getting it wrong. It's rare in that sense, and that they'll just penalize you if you don't do it right. And there's 5 different ways that you are required to file this. One of them is if you own 10% of a company, of a CFC or something like which is a controlled foreign corporation. There's a few different factors that can trigger that, but it's important to know about if you do own or operate a foreign corporation.
So the key takeaway here is that it's not as easy as just getting the FEIE and you're free and clear. There's other forms that you need to talk to your accountant about to make sure that you're filing everything, right?
Yeah, absolutely. Yeah. And there's also another big concept we haven't touched on yet. It's called foreign tax credits. And so it's different than the foreign earned income exclusion. It's if you're paying taxes to another country. So if you move to Portugal and start paying Portuguese taxes, you can get a credit on your U.S. taxes for the amounts that you do pay. So say you pay $5,000 to Germany, that's a $5,000 credit you can get in the U.S. It's a little tricky because of timing. Not every country runs on the same calendar year that the U.S. does, so there's a little bit of timing differences. And you also have to balance the benefits of foreign tax credits against the foreign earned income exclusion, because you usually can't take both on the same income. So if you exclude all your $100,000 using the FEIE, you can't then take the tax credits in addition to it. But what the advantage is with tax credits, the equivalent of $6,000 to Germany, but you only had a $5,000 tax liability in the US. So you've got this $1,000 extra credit that can roll forward to future years. Whereas the foreign earned income exclusion, that's only in the current year. You can't roll that forward at all. And so if you do qualify for tax credits, you often want to get a CPA to determine what's actually more advantageous for you to take.
Okay, that makes sense. So, if I'm thinking I move abroad, I'm subject to another more higher tax rate, say like 50%, one of these very high ones. That additional tax above what I would have paid in the US isn't just like, oh, this was a terrible year. That credit will roll forward and be applied to the US taxes I'm paying going forward.
Yeah, it's a US credit. Yeah, you would apply to your US taxes. That's right.
Cool. So over the 2-year period, the idea is that effectively I've paid the same taxes total to, albeit to different governments, that I would have paid to the US, right?
Right. Yeah. Yeah. Exactly. And so it gets tricky. The form is a little complicated, and it gets really tricky when you're dealing with corporate taxes. But the same concept applies at the corporate level too. But that is the general concept. Yes.
Makes sense. What else should I know about? I mean, I know when you're in the US, you're paying into things like Social Security, and to receive Social Security when we're 95 years old and we're actually eligible, or whatever the new age would be.
112.
Yeah, exactly. You have to have paid into Social Security for like 40 quarters currently.
Yeah.
Is this something long-term expats should be worried about, that they're not paying into this and therefore wouldn't be eligible for this Social Security Ponzi scheme that we'll probably never get anyways?
Ponzi scheme. I don't know if it's a Ponzi scheme. It's a Ponzi scheme. Yeah.
By definition, you're paying into it, and
hope that it works. Yeah, so it depends, because like I said, the foreign earned income exclusion doesn't apply to self-employment tax and payroll tax. That is Social Security. That's what self-employment tax is. So they're required to pay into that still, because theoretically, when you do retire, you will still be a beneficiary of Social Security. With that said, there are strategies to eliminate that or greatly reduce it. Like even an S corp will reduce your self-employment tax. Will ultimately reduce what you actually receive in Social Security if you ever go on it. And so you do need to be cognizant of that and careful of that, because if you do go with these strategies to reduce your self-employment or payroll taxes, then and you don't save, then you're screwed when you retire, which I hope that doesn't happen. There's also something called a totalization agreement, which is an international tax treaty between the U.S. and other countries, some other countries, and you can just Google. There's a list of what countries have it with the U.S. Basically, what that is if you're paying into another country's Social Security system, you are precluded. You don't have to pay into the U.S. Social Security, but you can still get credit for having paid into the system. So if you're paying into, the UK, it's not called national insurance, I think it's called in the UK, same thing as Social Security, then you don't have to pay into the U.S., but you can, if you retire to the U.S. or something, you can still go on Social Security when you're old.
So same idea as the foreign tax credit. You're paying somewhere, so you're getting credit for that in your home country, essentially, right?
Yeah, kind of. Yeah, it's different than the foreign tax credit, but in the sense that you're paying to one country, and
right?
Yeah,
getting credit in your home country. Yeah.
Yeah.
Hypothetically speaking, if someone were to not be thinking that there's much Social Security there when they reach that age, then it would behoove them to minimize the amount they're paying into it now, because that's more money in their pocket now that they can invest in other ways, and ideally have a bigger amount than they paid into Social Security. Is that correct?
I mean,
there's a number of personal factors. Obviously.
Yeah. That's what I do, if that helps. Yeah. Still pay not self-employed. I pay payroll tax, but I still pay it, but I reduce it through tax strategies, because the benefit that you receive now would be, at least for someone in our position, let's say, it would be better to save now and just invest it than get it eventually in theory, 60 years down the road.
Yeah, I guess it works well for somebody that spends all of their paycheck, so it's withholding, it's forced savings in a sense, or it's not in a sense, that's what it is, right? They're investing it for you for your old age. I just, I come from the pensions, whether it be at the company level or at the municipal level, are completely underwater and going to have some serious issues in the coming years. So it's definitely, it's going to be something we're going to work through. That's for sure.
Yeah. I mean, I don't know. Cause on the other side, people have been saying this forever and it's still around, and, people are still going on Social Security, and, old people still vote. So, and in fact, they're pretty much the only people that vote, as I understand it. So
very true.
Yeah. And so, I think Social Security is a little protected in that sense, but, again, it's speculation. I'm not sure.
Well, it's protected for now, but what happens when we are actually looking to pull from it? If a bunch of these other more elderly people have been pulling from it the whole time, and we're not reproducing at the same rate. So get out there and make some babies, the people listening to this.
Yeah, please do. I'm not gonna. So
no, we need lots of them. Bring them on. And then the whole ecological impact of that is a whole nother story, right?
That's for the next generation.
Yeah, we're talking about finances and Social Security here. That's where where it is.
But the takeaway is make sure you save and are doing your own thing and investing and have some of your own financial resources. Don't retire entirely on that, for sure.
And do you have any good resources, places to look for somebody? Do you have any guides or anything on your website that kind of helps people understand some of the key concepts that we've talked about here?
No, to be short, it's, it takes a long time to actually learn this stuff, and there's not a lot of good resources and literature on it, which is why you have to go get a 5-year accounting degree to be a CPA and things like that. But if you are interested in learning, like I said, I do offer consulting, or you can just tell me your general state of where you're at financially and your plan is, and I'll just give you the general rules. So it's not just me too. It's just best to really talk to someone about this who can consolidate all the rules and also filter out all the misinformation, because there's a lot of it out there on these online articles, and tell you what you need to know based on your position. So that would probably be the best route if you're interested in learning more.
Yeah, and that's an important note, right? Is tax advice is very difficult to broad brush give to anybody. It very much determines on your individual situation. Sure, and obviously the disclaimer here that none of this is tax or financial advice, whatever we're talking about, that applies as well, as it always does.
Yeah, of course. Yeah. But happy to help if anyone needs. And also you're just a little point of caution. Not most accountants, I think, aren't going to be able to speak to this. You should definitely, if you're interested in this kind of stuff, speak to an international accountant for sure, because your standard CPA is not going to know what the foreign earned income exclusion is, or not going to know what tax credits are, or anything. And they might even be really good at what they do, but it's a very specialized niche, I think. And so maybe look for some international specialists.
Definitely. And a growing niche. I think you've well positioned yourself. So WayFarer has been completely remote from the beginning, which I also think is very fascinating, because all of these CPAs and accounting firms that, smaller firms that think they need an office, and they have an office. Yeah. Now they're closed for 6 months, and they're like, wait, did we actually need an office this whole time? Like, what are we doing? And you're like, yeah, man, I've been doing this whole time. Like, it's an office. Like, I'm available. I can span different time zones, whatever.
Exactly. Yeah. It's not just accounting. It's every industry. It's realizing, why are we spending money on this stuff? Why are we doing it this way? And I joke with some of my colleagues and people that I talk to. They when I first started, I was a little uncertain of myself. Let's say, and I was living in Colombia when I was first learning the ropes, and when I would talk to people on the phone, I would try and project myself as this
real grizzled old, like 60-year-old accountant with 40 years experience in this back room with his visor and 10 key calculator. Because I thought that's what people wanted.
Protector.
And the pocket protector. Yeah, of course. And I tried to like, pretend like I was that and so that people would trust me more. The complete opposite is true. I learned very quickly that no one wants to work with that person over, someone who's just enthusiastic and exuberant and like in the same position as they are too. And so I found that me being a digital nomad has helped me work with digital nomads and expatriates and things like that. That's who they want to work with, people who they can connect with. And so it's good to have, staff and employees, or if you own a business, to get out there and do stuff. You don't need to be the guy in the office. Yeah, there's no point in it.
Mark, really appreciate you coming on, having this conversation. Where can my listeners find out more about you, about Wayfarer? Where do you want to send them?
Sure. Yeah. You can check me out on my website, just WayFarer Accounting. WayFarer is spelled WayFare, WayFareAccounting.com. Shoot me an email if you like. It's mdissen@WayFareAccounting.com, MDISSEN. On that, Google me, happy to help. Let me know what you need.
Definitely. And I'll link all of those things in the show notes, but really appreciate it, Mark. Thanks for coming on today. There you have it. Thank you for listening. I really appreciate your support. Show notes, transcript, links, and more can be found on our website at altassetallocation.com. If you'd be so kind, please share this with anyone you think might be interested or get some value from this conversation. If you have any questions or comments, please reach out. I'm always happy to hear them. Lastly, if you're on YouTube, please like the video or subscribe to the channel. If you're listening to the audio version of this, please subscribe to the podcast and or leave a review. This really helps more people find the podcast, and I really appreciate it. Thanks again, and hope you have a fantastic day. Happy investing.